The 2008 financial crisis had a major effect on the global economy, exposing weaknesses in the banking industry and prompting action from the government. The collapse of Lehman Brothers and subsequent bailouts underlined the necessity for strong regulatory structures to avert future catastrophes. As a result, big banks were compelled to develop living wills. These living wills guarantee that even the biggest banks can be disposed of in an organized way, reducing risks to the overall economy. However, recent disclosures from the Fed and the FDIC have raised questions about the financial strength of these strategies for three major American banks. JPMorgan, Bank of America, and Citigroup have come under pressure. The Federal Reserve and the FDIC have raised worry about the bank's attempts to shrink its sizable derivatives portfolio. This is an important issue because if banks are unable to clear large positions efficiently, the institution's financial viability may suffer. Understanding derivatives and their importance. Derivatives are financial contracts whose value is based on the performance of underlying assets like stocks, bonds, currencies, or even interest rates. While derivatives can bring enormous benefits by facilitating risk management, they also carry significant hazards. If not managed effectively, derivatives can result in significant losses. JPMorgan, Bank of America, and Citigroup have huge derivatives portfolios. Simply put, these institutions are heavily involved in agreements that, depending on market conditions, could either make or break them. The ability to reduce or properly terminate these holdings is critical to the bank's financial sustainability, particularly during moments of economic crisis. Regulators' concerns. The Fed and FDIC have revealed flaws in these banks' resolution strategies. Resolution plans, often known as living wills, are tactics that banks must publish to demonstrate how they plan to conduct orderly wind-down operations in the event of financial trouble or failure, while causing little disruption to the financial system. The regulators have discovered particular flaws in the living wills of JPMorgan, Bank of America, and Citigroup. These banks were discovered to be incapable of unwinding their huge derivatives portfolios in a timely and effective manner. The importance of living wills in banking. A living will, commonly referred to as a resolution plan, is critical to maintaining financial stability. It necessitates that banks thoroughly plan for failure so that they may be closed down without requiring taxpayer-funded bailouts or resulting in significant economic disruption in the case of a tragedy. The living will requirement requires banks to identify and map out their complicated organizational structures, assess their relationship with other financial institutions, develop tactics to facilitate rapid asset liquidation and debt resolution, and establish plans for keeping up vital activities throughout the wind-down process. The goal is to put the responsibility for handling failure by the banks themselves, rather than depending on public funds to avoid systemic crashes. Historical context: the 2008 financial crisis. For an understanding of the scope of this scenario, consider the 2008 financial crisis. The collapse of Lehman Brothers, as well as the subsequent rescue of other big financial firms, were largely caused by failures to manage sophisticated financial instruments such as derivatives. Following the crisis, regulatory reforms were implemented to guarantee that banks were able to wind down their operations in a structured manner. According to the regulators, Citigroup has the most substantial deficiency among the banks. According to the FDIC's assessment, Citigroup's proposal would not allow for an orderly resolution under the US Bankruptcy Code. This is a big worry, since it demonstrates that Citigroup may be unable to weather a financial downturn without creating widespread disruption. JPMorgan and Bank of America, while similarly weak, got less harsh criticism. However, the authorities recognized significant constraints in their ability to get rid of derivatives holdings. The main issue with these banks was their failure to effectively test and manage their unwinding strategy under varying market conditions. This implies that their current preparations are insufficient to address potential financial crises. Regulatory and market pressures. Regulatory organizations have called on banks to improve their risk management. The Federal Reserve and other regulators are concerned about the possibility of a catastrophic event if banks fail to unwind their derivative contracts and other hazardous assets. Derivatives can assist hedge risks, but they can also contribute to increased losses amid economic downturns. The regulators' observed shortcomings have a number of consequences. First, banks might be forced to alter their resolution plans to fulfill regulatory requirements. This could entail considerable restructuring and a reduction in their dependence on high-risk derivatives. Such modifications may have a short-term impact on profitability, but they are required for stability over the long run. Second, the findings may have an impact on the bank's reputation and market trust. Investors and stakeholders may become concerned about the bank's financial stability, leading to greater scrutiny and greater borrowing rates. This could have an impact on the bank's stock price and total market worth. Finally, the broader financial implications cannot be overlooked. If these major banks fail to successfully manage their derivatives assets, the financial system as a whole may suffer. Regulators provided banks an opportunity to resolve the identified flaws. The banks are anticipated to present revised plans that demonstrate their ability to unwind derivatives contracts without causing considerable disruption. This includes implementing effective internal controls and risk management measures, as well as maintaining visibility and clear interaction with authorities. Actions for banks. Given the authorities' findings, JPMorgan, Bank of America, and Citigroup must take a number of steps to correct their inadequacies. Revise resolution plans. Banks must rewrite their living wills to guarantee that they may unwind their derivatives investments in a variety of market scenarios. This could entail conducting more thorough stress testing and scenario analysis. Increase the capital buffers. Raising their capital holdings can give another layer of safety. Banks can better absorb losses and stabilize during times of financial stress by keeping more money on hand. Challenges in developing successful living wills. The problems these huge banks encounter in making a decent life will highlight several underlying obstacles. Improve risk management by strengthening internal controls and frameworks. Banks need strong systems to monitor and control their derivatives exposure. Improve transparency. Open and forthcoming interactions with regulators and stakeholders are going to be required. The banks must submit thorough information on their bankruptcy plans and demonstrate their capacity to carry them out efficiently. In conclusion, major banks, including JPMorgan Chase, Bank of America, and Citigroup, have inadequacies in their living wills, raising worries about regulating systemically significant financial institutions and avoiding future financial catastrophes. Partnership between regulators and financial institutions is critical for addressing these issues. Thanks for tuning in to another eye-opening episode on capital crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts, smash that subscribe button, and share this video with the squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.